Excellent, that's better.
Yes, so again, welcome everyone. Thank you for joining us today at Mondays at Murdoch. I am Manuja. I look after all branded communications at Murdoch University, Dubai. And we are joined by our very familiar and lovely Giles Coghlan from HYCM today. And today, Giles will be taking us through essentially how central bank policies impact foreign exchange markets. Now, before we delve into a little bit of how this information is critical or important, obviously, for professional investors all around the world and how they use this policy decisions to make their own investment choices and how that impacts financial markets all over the world, I would like to quickly introduce Giles, who's been very kind to return to these Mondays at Murdoch sessions. It's Giles' third session with us, and I think for us as the university, and we just started these last year at the start of COVID, this is our 28th session, so I think we're very happy with that as well. But yes, as Giles mentioned, and I now know he resides in Birmingham, but he's the chief currency analyst at HYCM, I'm sorry. He has, since joining the company in April 2018, Giles, you've played a key role by providing your expertise to the investors at HYCM, and with over 11 years of experience in trading, you are committed to helping traders by sharing real-time analysis. We do have people who follow you present in this webinar as well. And being this expert and this voice in the markets, Giles is also often quoted in Yahoo Finance, NASDAQ, Forbes, CNBC Arabia. So it's, again, great having someone as gifted and engaging and helpful as you join us today. And I will let you take it away now.
Thank you very much, Manuja. Well, it's a very privilege to be back here again with you all here at Murdoch, and really looking forward to the session. So particularly warm welcome if you're able to join me today. And you've made a good choice, because what I'm going to be sharing with you today is really the foundation of trading the FX markets. So the actual title of our session today looks rather boring, doesn't it? How central bank policy impacts FX markets. But actually, the concept is really quite simple once you've had it explained. And also, it's quite profound in that the FX markets are driven by this central bank policy. And, you know, just spending maybe half an hour, you will get the basics of how the FX markets move in relation to central banks. So as Manuja said, I work with HYCM. They're a broker established in 1977 and been in Dubai since 2006. I have to say, I love Dubai. I usually visit 5 times a year. I've really missed not going this year, but I hear the sun is shining and looking forward to coming at some point. We are regulated across the world. This is the introduction to myself. I won't go through that again. And we have global offices all over the world. So that's the broker that I work for, HYCM. And the topic we're looking at today is how central bank policy impacts FX markets. Now, the first thing to understand is, what is monetary policy? Well, monetary policy is simply an action that a central bank takes to influence how much money is in the economy and how much it costs to borrow. Remember, a central bank wants to make sure that the currency is moving in a smooth, a predictable way, so both exporters and importers can rely on a stable currency. Obviously, the more stable a currency it is, the easier it is to plan. If the currency stays at a very stable interest rate or a stable exchange rate, it means it's easy to plan for the future. So a central bank really wants to make sure that it keeps its currency as stable as possible, and it has a job to communicate to investors and the whole of the country that it represents what its policy is. a central bank doesn't want to surprise its people. It wants to keep its people informed and able to plan. So fundamental analysis involves studying central bank policy to see which direction a currency is likely to go, because the central bank literally explains it so it can be reliable. Now, the best way of understanding a monetary policy and a currency is like this. You see on this image, you have a car and you have an engine. It's a simple illustration, but it will make the point. If you have a car without an engine, the car won't move, because the car has to have an engine to move. Now, a central bank's monetary policy moves a currency just like an engine moves a car. So if you imagine it like this, you've got the central bank, and the policy that the central bank has decides whether the currency moves higher or whether the currency moves lower. So people like myself study exactly what the central bank is going to do, especially if we're trading in the FX markets. If we're trading currencies, you have to know what the central banks are doing. Now, there's 8 major central banks in the world, and they're not all equal. So you might think, okay, central banks, the Bank of England, the Swiss National Bank, the Bank of Japan, well, they're all the same, aren't they? The Reserve Bank of Australia. You might think of them like 8 counters on a board. But that's not the case. Central banks are different in terms of their importance. Now, the most important central bank is the Central Bank of the United States. It's called the Federal Reserve, or it's just simply called the Fed. So if you ever hear an analyst or a commentator talking about the Fed says this or the Fed does that, what's the Fed going to do? It's talking about the Federal Reserve. And it is the most influential central bank, and its policy influences all the other central banks' policies as well. The way to think about it is, if you imagine the Federal Reserve is like the Pied Piper. You know that children's tale when the Pied Piper played his tune, all the children followed the Pied Piper. Well, the Federal Reserve is like the Pied Piper. When it gives its tune, when it makes its monetary policy clear, it impacts the whole world. And the world is dollar-centric. It's not called the king dollar for nothing. So in terms of understanding the hierarchies of central banks, in your mind, you should have 2 things securely in it now. 1, central bank policy determines the movement of currencies. 2, the most influential central bank in the world is the Federal Reserve. If you've got those 2 points in your mind, you are quite a long way to understanding how the FX markets are moving day to day. I'm now going to unpack that for you, that broad principle. I'm going to unpack that into some detail and show you how that practically works out day to day. So remember I told you that central banks want to make sure that currency movements are smooth, predictable. Well, I'm going to show you now, there's 4 key elements that central banks focus on in order to keep currencies and the economy running smoothly. So the first 2 are production and employment. Now, production is obvious. It's how much manufacturing is going on. What's the services industry like in the country? How many new buildings are there? How many new businesses are being started? How many are closed? What is the employment level? Are people finding more work in the country? How many people are unemployed? Now you look at that across the world, it varies widely. In Australia at the moment, there's about 5.5% of the working population are unemployed. Sadly, in Greece, it's as high as 15, 16%. So central banks are very focused on how much people are working in their country, and it's important for them to know that. They also want to know how much are those people earning. Are they earning more in their salary than last week or less? They also want to know how many people are working full-time. Are more full-time workers or are there less full-time workers? Obviously, full-time employment is very important for the labor market. Now, the two of those four that are the most important are growth and inflation. So growth is obvious. It's like the GDP. What is the final amount of finished products in the entire economy? Inflation is important because what is the costs of goods and services? Now, you are finance students here, so you will all know what inflation is. It's very simply the costs of goods and services. And when inflation is going up, it means the costs of things are increasing. And obviously, inflation can be a big concern for a central bank, because if you earn your salary at the end of the month, you do your shopping for the month, and if you you say you get 100 items from the shop and say it costs you $100. Now, when inflation is taking place, if inflation was 10%, it would mean that the same items that you bought now cost $110 when inflation has taken its effect. So as you can imagine, that's a very destabilizing impact on a country's economy. And if inflation rises too fast, too quickly, that causes another effect, which is people fear inflation, and because they fear inflation, they drive inflation higher. Let me give you an example. If you thought the price of something this month was going to cost $20 more next month, what would you do? Well, you buy it now, wouldn't you? And if you imagine everyone around the country thought that everything they were going to buy this month is only going to cost more next month, then they buy more and more and more of the product. And that way, inflation gets higher and higher and higher. Now, I'm sure you've seen the pictures of hyperinflation in Germany, when inflation got out of control, and as soon as people earned their money, they spent it, because they knew that even waiting one day, your wages would be worth less than when you earned them. So one of the real big focuses at the moment in the financial markets is inflation. If you follow the financial markets, you will see that many people are worried about the rise in inflation and whether the Federal Reserve is being too relaxed about the inflation that we're starting to see. And that's one of the reasons. Now, if you were born, say you were born around 1990s, in the year 2000, you have probably, or possibly, certainly if you're in the West, you have never seen a high inflation economy. You know, you look how low inflation has been in the West, and particularly look at Japan, very, very low inflationary environment. And so we're not used to the concerns that there can be in a high inflation environment. Now, a central bank is concerned about inflation, and most central banks say that they want to keep inflation around 2%. That's the majority of the world's central banks. So in other words, when inflation rises, central banks, you have to excuse me, unfortunately, I have hay fever here in the UK, and so I may sneeze a few more times. I apologize for that in advance.
Bless you. I can't not.
Thank you, manager. That was very kind of you. So a central bank worries about inflation. So now let's go back and let's summarize. Central banks have four indicators they're looking at: production, employment, growth, inflation. Okay, production, employment, growth, and inflation. And those four indicators will impact what monetary policy the central bank has and how that impacts a currency. Now, they have four different ways of impacting a currency a central bank has. And these are the four ways. One is by controlling interest rates. Two is by doing something called price control. Three is by the language that central banks use. Who would have thought that words can move currency markets? I'll show you that they do every single week. Fourthly, quantitative easing, asset purchases. So these four tools are a response to the four key indicators that central banks focus on, and these actions end up moving currency markets in different ways. So let's investigate and let's find out exactly how they impact currency markets. Well, first of all, what we see here is interest rates. This is the number one tool. Now, the central bank sets the rate that banks are charged for borrowing money from the central bank. And this is the major way that central banks control inflation. Remember I said to you that central banks need to control inflation? Well, they have one tool that really controls inflation, and that is by setting interest rates. So here's an example of how it works. Now, this is a chart of the US dollar, Canadian dollar currency pair. If you're not familiar with how currency pairs are traded, very simply, when this chart moves down, it's a sign that the Canadian dollar is strengthening and gaining value. So here's an example where the Central Bank of Canada surprised markets by increasing interest rates. So what that means is that they charge more money, they charge a higher rate to borrow money from the central bank. So that means when you put your money in the bank, it gains more interest for you. Because a central bank, when it hikes interest rates, it attracts more investment, the currency goes up. So when a country increases its interest rates, the value of the currency rises because demand for the currency increases, because investors, for instance, people like myself say, aha, the central bank has moved its interest rate. I want to move my money that maybe is in pounds, or maybe it's in the Swiss franc, maybe it's a US dollar. I think, oh, I want to move it into the Canadian dollar because I will now get a higher interest rate by owning Canadian dollars. And that causes the value of the Canadian dollar to rise. Now you can see here that on the chart, you can see the red line. And as the price fell, that's the signal that the Canadian dollar is gaining in value. And you can see here, it was an unexpected interest rate hike. What you're looking for in the financial markets is surprises. When something's a surprise, it's when you get the strongest reaction. So imagine, to make this point, imagine if I said to you, right, you're going to come to my house on the weekend, and I've decided that I'm going to cook us some soup, and we're going to have a nice chat together, and we're going to have a nice bread roll and sit in my garden. So you come to my house and you're expecting to have a nice time with me, sit down, bowl of soup, have a chat in the garden, enjoy some time with me. But when you arrive, I say, change of plan. We're going to London. We're going to stay in the Ritz Hotel. We're going to have a banquet, and we're going to go out to the West End Theatre, and we're going to have a fantastic. Wow, you'd be like, Joe, wow, that's amazing. That's much better than the soup that I was expecting. Yes, forget the soup. We're going to the Ritz. So what you're looking for is a surprise. It's in exactly the same way. When a central bank surprises the markets, like happened here, and there was a sudden interest rate change, that's when you see the biggest impact. They're the kind of moves that someone like me as a currency trader is really looking out for, because I know I'm going to get significant movement in the currency when that happens. So here's another example. This was when the Reserve Bank of New Zealand, they surprised markets by cutting interest rates. So they made interest rates lower. So it meant that you don't want to hold New Zealand dollars. It means you sell your New Zealand dollars. And you can see here on a very small time frame on this chart, the New Zealand dollar lost value rapidly. And you can see here, this was a live trade from my trading account. You can see here, the little red line was where I entered, and the little red line, the little red arrow is where I exited. So you can see I entered at 68.49 roughly, and I took profit at about 67.72. So I made a substantial profit in a very short period of time because of the change in interest rates. Here's another example. This is when the Reserve Bank of New Zealand surprised markets by cutting interest rates. You see the New Zealand dollar strengthened. This was a trade that I took during COVID-19. So here, what you saw was the Bank of Canada cut their interest rates by 0.5%. Now, this was an example where I traded one currency, a strong one, which was the Japanese yen, because when investors are frightened, they buy the Japanese yen. The Japanese yen is seen as a very stable currency, and in times of crisis, investors buy the Japanese yen. In fact, the Japanese yen is considered such a reliable safe haven currency, and it's due to the way that the debt is structured in Japan, that the debt literally belongs to all the inhabitants of the people in Japan. So if you were Japanese, you take on partial responsibility for your nation's debt. As a result, the Japanese yen is seen as a very safe currency to have in times of crisis. So it's considered so safe that even when an atomic bomb was dropped on Japan, the Japanese yen gained in value. That's how incredibly strongly valued it is by financial markets. So when the Bank of Canada cut interest rates, we know what we expect. A cut in interest rates means that it's less attractive to hold the Canadian dollar, which means the Canadian dollar falls. So you can see here on the chart, here was an entry. I took the little red line and I sold it all the way down from just under 80, sold it all the way down to 78.37, making 137 points. Here's exactly the same trade, but on the Swiss franc. The Swiss franc is another safe haven currency, which again is seen as very reliable. Remember, the Swiss economy is seen as a very stable economy, huge banking reserves, huge gold reserves in Switzerland. And the geography of Switzerland, surrounded by mountains, has meant it's been able to avoid many wars over the years. It has a fantastic geography. And for those of you who know geopolitics, you know that actually the geography of a nation impacts its politics. And for Switzerland, it's been able to take full advantage of being shielded away in those mountains. Almost impossible for an advancing army to attack. The Swiss have been able to stay out of trouble for centuries. And that's been fantastic for their economy. And of course, many people, particularly in Europe, realize if I want to put some money someplace during a time of crisis, Switzerland is a great place because all my income can be surrounded by those beautiful Swiss Alps. So the Swiss franc tends to gain on safe haven concerns. And here you can see the Canadian dollar Swiss franc, again, 145 points on that interest rate cut. Remember, it was because it was a surprise that we saw such a strong reaction. That's what you're looking for the best opportunities. So let's bring it up to the current day. On Wednesday, the Federal Reserve, which you now know is the world's most influential central bank, is meeting. if they surprise markets and increased interest rates, what would happen to the dollar? Feel free to answer in the Q&A box or the chat box. Feel free as well to answer questions at any point during this presentation. I will happily take questions. Yes, I know some of you here know this. This is very simple for you. Some of you, this may be new. But if the Federal Reserve surprise markets and if they increase interest rates, yes, of course, the US dollar gains in value. So here was another example, but this time showing you how the central bank policy impacts a commodity market with the US dollar weakness, because the Federal Reserve surprised markets during COVID-19 and they cut interest rates by 50 basis points. The dollar weakens, which means gold rises. Very similar with silver. There's just another couple of trades that I took. By now, you should have learned a couple of things. One, that interest rates are set by central banks. Two, when an interest rate increases, the value of the currency rises. When an interest rate is cut, the value of the currency falls. That is a very reliable and predictable reaction in the FX markets, especially over the short term. So over, a short term in trading, if a central bank says they're going to cut or raise interest rates, you can expect a sudden and volatile reaction in accordance with the way I've outlined. A strong currency will be as a result of interest rates being increased. A weak currency will be a result of interest rates being cut. Now there's a second tool. The second tool that central banks have, and it's one they use a lot less now because of the fact that it doesn't always work. So the central bank can do what's called price control. And you see here a chart on the euro-Swiss franc currency pair. Now, back in the financial crisis of 2008 and 2009, the Swiss economy had a problem. And the problem, remember I told you that the Swiss franc is seen as a safe haven currency. Well, it was seen as such a safe haven currency that lots and lots of people bought the Swiss franc. And the Swiss franc became so strong that it became a problem for the Swiss export economy. You know what the Swiss export? Beautiful watches, chocolate, luxury goods. They have a very nice export market, a lot of very nice products, high end, but if the Swiss franc becomes too strong, it means the price of those lovely export products that they produce gets more and more and more expensive. And obviously, if you go to the shop and the Swiss watch that you really want to buy, if it's going up and up and up in price, eventually what happens, you say, oh no, I won't buy my Swiss watch at that price. It's too expensive. And so the Swiss exporters were saying to their government, the price, the value of the Swiss franc is too strong. We're losing business. So the Swiss National Bank, it's their job, remember, to have a smooth currency. So they have to act. So the Swiss National Bank said, don't worry, we have a solution. We will do what's called price control. So we will make sure that the 1.20 level is maintained on the euro-Swiss franc pair. In other words, we won't let the Swiss franc strengthen anymore. And what they did is they bought euros and dollars in billions and billions of pounds worth to make sure the Swiss franc didn't get any stronger. They invested so much money. And then, sadly, they decided they couldn't do it anymore. Do you see that price fall? That's when the euro-Swiss franc currency pair lost about 40% of its value. So the Swiss franc strengthened about 40% in about 10 minutes. Hedge funds collapsed. There were brokers that went out of business on this. And many individuals lost all their savings because the Swiss National Bank said, we give up. We can no longer stop the Swiss franc from getting stronger. We're not going to buy the euros. We're not going to buy the dollars. We're going to let the exchange rate move smoothly. And this has been the problem that central banks have had. They can try to defend a level, but eventually one country can't hold back the world. And that's the problem. There's lots of conspiracy theories, aren't there? You know, that two individuals are controlling markets, etc., etc. And of course, there is market manipulation, but there isn't market manipulation on the scale of even when a central bank like Switzerland wants to manipulate a currency, it was unable to over a prolonged period of time. So it's a lesson. And central banks have learned that lesson. And most central banks now won't try to hold a currency in place. But if they ever do, just remember the Swiss National Bank, because most central banks have learned that lesson and won't repeat it. But occasionally a central bank will say something like, well, we think the currency is too strong. We think the currency is too weak. So they'll let the market know what they think, but they less and yet less use this pegging technique. People's Bank of China, there was talk about them holding the 7 level against the US dollar, Chinese yuan at the end of 2019, but they didn't even attempt holding it because they've learned the lesson from the SNB. The third tool is language. So remember I said the central bank, it wants to avoid surprising markets, so it makes statements. And often a currency will rally higher or fall lower on 2 or 3 words in an interest rate statement. Investors look at central bank language very carefully. Central banks use their language very, very deliberately. So it's a bit like this. Imagine a little child wants to go to the park with their father or their mother. And the little child says, Dad, can we go to the park? And the dad goes, we can go to the park next week. Okay, so the child thinks, okay, I've got to wait a week until I can go to the park. But then the child asks the same question the next day. It says, Mummy, Daddy, can we go to the park? And they reply, we can go to the park shortly. Now, what does the child think? Oh, that's much better. Shortly is sooner than 1 week away. Well, investors are just like that little child. When the central bank changes its language subtly, investors read into that language change what's going to happen. There's many different examples of this. So here's an example of a trade I took just a few weeks ago. Now, this was on the Reserve Bank of New Zealand. Now, the Reserve Bank of New Zealand, they had their interest rate statement, and they said that they were now expecting to raise interest rates in 2022. Now, before that meeting, they said they expected to raise interest rates in 2024. So do you remember what I said? When a central bank increases interest rates, the value of that currency goes up. So in this instance, a strengthening New Zealand dollar is a falling Aussie New Zealand dollar pair. So here, it's the language. When the language changes, investors say, aha, there's a shift. It's going to be a sooner interest rate hike. That means we should buy the New Zealand dollar now. Remember, traders, they're always looking like 6 months, 12 months in advance. Let me show you how advanced traders look. So here's an example. Let's just take, I'm going to take the commodity market. Let's take copper. This is the copper chart, 1 month. And do you see when copper is essentially the commodity that is representative for global growth. When the world is getting better and things are looking good, copper prices increase. Think of what you use copper for. buildings, wiring, green technology. Demand for copper means that good times are coming. So look when copper prices started rallying. This is the chart. Copper prices rallied sharply when? April 2020. Because that was copper traders saying, well, look, we're not going to be having a COVID-19 virus forever. Eventually, we're going to deal with this virus. Eventually, economies are going to recover. And when they do, we know there's going to be demand for copper. And on top of this, copper mines were closing because of COVID-19, but demand was likely to be coming. And so copper prices just rose and rose and rose. And on my blog, you can see my blog here. I'll give you links to this at the end. But I was, explaining this dynamic for traders for some time. So you can see from May 2021, March 2021, going back all the way, November 2020, just explaining what's going on there in copper. So the point I'm trying to make to you is that currency traders and commodity traders, they're always looking in advance. So by the time something happens, the moves have already happened. So if you're trading, you have to be anticipatory, or there has to be a complete shift. They're the two things you're looking at. Here's another example, the language. We expect to keep the official cash rate, this is what New Zealand said, going back to 2018, but it makes the point. We expect to keep interest rates at this level to 2019 and into 2020 longer than we projected in our May statement. So they're simply saying, we expect to have interest rates lower for longer. So that means the New Zealand dollar weakens because people aren't expecting interest rate hikes. It's lower for longer. And there you can see the New Zealand dollar lost value against the Australian New Zealand dollar. Another example from the Reserve Bank of Australia. They simply said that the forecast now, the sets of scenarios are more evenly balanced. So that's just saying, well, for about 2 years, the Reserve Bank of Australia in this context was saying interest rates are the same, but when we change them, we're going to raise interest rates. They said that for about 2 years. Then all of a sudden, out came this statement where they said, in light of the recent data and the inherent uncertainties around the forecast, the probabilities of these two sets of scenarios have shifted to be more evenly balanced. Do you see the shift in language? So now they're saying we're more neutral, we're more balanced. And that resulted in the Australian dollar falling because traders were no longer expecting an eventual interest rate hike. There you can see. Another example from the Reserve Bank of New Zealand. They said it remains at 1.75%. This was obviously before COVID. It says, given the weaker global economic outlook and reduced momentum in domestic spending, the more likely direction of our next official cash rate move is down. Aha. Now, prior to that statement, what they've been saying is they were saying, it could be up or down. But the language shift is down. So it means the interest rate is more likely to fall. So the value of the currency falls as well. Well done. If you're still with me, you're doing well. We now get to our fourth and final tool, which is quantitative easing. Now, this is simply a tool that central banks use to inject money directly into the economy. So money can be physical, like banknotes and coins, or it can be digital, like the money in your bank account. And quantitative easing basically involves creating digital money. And this digital money is used to use government debt and things like bonds. It's referred to as QE, asset purchases, easy money. All of this is just saying quantitative easing in the same way. And when a central bank uses quantitative easing, they bring more money into the market. So it means the value of the currency is devalued. So the value of the currency goes down. So if at the Federal Reserve meeting, if they said, we're going to reduce our bond tapering, and this is, the big topic at the moment in the financial markets is, will the Federal Reserve reduce their asset purchases? Will they reduce their quantitative easing? If they reduce it, they're saying we're cutting back on the QE, which means the value of the US dollar goes up. Now, if they said we're going to increase it, which is highly unlikely, but if we're going to increase it, the value of the dollar would go down. So the amount of quantitative easing that central banks use is absolutely imperative for the value of a country's currency. And you can see here, this is when the Bank of Japan, they started their QE program in 2013. And look how the Japanese yen lost value against the US dollar. And that was a trade that many investors, they held it for years, taking in the interest rate every single day from the rollover in the FX market, every single day collecting the interest on their payment for years and years on years, as the Bank of Japan unleashed an enormous quantitative easing program, which just weakened the Japanese yen. And for those clever traders who knew what that reaction would be, they just took full advantage of that move. And there can be some very profitable moves in the currency markets. So I think I made a mistake with this webinar because I think I gave it a very boring title. But actually, this is one of the key fundamentals to trading FX markets. I should have called it The Secret to Trading FX, shouldn't I? And then we would have had more, we know what I mean? Medusa's nodding in agreement. I just had the wrong title. I didn't make it attractive enough. So those of you who have come to this webinar, well done, because you have got the core fundamentals of how FX markets work. And the key aspect that I teach traders is always look to back the strong against the weak when you're currency trading. So this is how because currencies are traded as a pair. So this is how you pair them together. Now, if you look at the arm on the left, that's a strong arm. You look at the arm on the right, yes, it's a strong arm, the arm on the right, but it's not as strong as the arm on the left. And if those two had an arm wrestle, which arm would you expect to win? Well, we'd expect the big arm to win, wouldn't we? Now, when you have that very simple mental image, instead of thinking arms, think currencies. When we're trading, we're looking to pair a strong currency against a weak currency. And that way, we put the balance of probabilities in our favor. Now, it's not going to mean you're going to win every trade. And there are many nuances to what I'm teaching here in terms of timing your entry and how you practically make it work. But the key concept is this. You're looking to pair a strong currency versus a weak currency. So for instance, imagine you had two central banks. One on the left raises interest rates. That makes the currency strong. The one central bank on the right cuts interest rates. That makes the currency weak. So you would know, I'm pairing a strong currency with a weak currency. And by doing that, you can have the odds more in your favor. Now, in a moment, I'm going to get to the Q&A questions, and I will answer the questions that you have. I just want to point out a few resources that I have. First of all, this is a link to my blog. Now, this blog, I update every day. So if you want to find out more about central bank policy, I cover every single central bank interest rate meeting on my blog. Just go to Market Fundamentals, you go to Central Bank Watch, and you'll see here the go to the central bank watch, and then you'll see what we learned from all the central bank meetings. And I explain them, I go through them every single time they meet. And like most central banks meet about 8, 9, 10 times a year. And so there's plenty for you to cover. The other resource I have is, don't forget, you can follow me on my Twitter handle. I update lots of information on my Twitter handle, so you can follow me there. I also have a LinkedIn profile, so if you want to stay in touch with me, or you're looking opportunities for jobs, or just want to just stay in touch, use my LinkedIn profile. And I also run a trader training program where I've put together a very special package where I show people how they can trade at zero cost to themselves. I've managed to put up a number of different relationships together, and it's a way of getting training in trading for free. It's basically the program that I wish there was when I started to learn to trade. I've managed to put that together. So if you have any friends who are interested in FX and they're so confused, just give them the trader training program, help them out. I'll set them on the right path. I'll stop them trying to buy Lamborghinis and buy the Burj Khalifa after 2 days trading. I'll set their expectations correctly and help them show how that works. Great. Well, that's been lovely. I will now get through to the questions. So first of all, got a question here from Mornay. Mornay, great to see you here. Good afternoon. Great question. What is seen as the optimal interest rate an economy should operate on to ensure optimal growth? Basically, Mornay, the way it works is they focus more on inflation. So what they want to do, they're not as concerned with the interest rate level per se. Instead, they want to keep inflation around that 2% level. Inflation at 2% level means happy central bank. Pascalis, good to see you. My question is for the Fed's interest rate in US dollars. As far as we know, many emerging or poor economies have loans in US dollar. Correct. The Fed at the moment maintain very low interest rates in US dollar. But when they will start hiking rates because of the coming inflation, what will happen to the weak economies that they borrowed in US dollar? It means their loans become more expensive. Does their monthly payments increase? Yes. If this happens, we will have a domino of bankrupted countries. Turkey is a good example. Thank you. Pascal, you raise an excellent point. Taking on debt is one thing, but taking on debt that becomes more expensive is quite another. And this is a problem that not only emerging markets, but actually many economies, even in the wealthier economies, have got used to interest rates being extremely low. Remember what I said about inflation? Now, when I was younger, my parents, they lived through the 80s. And in the UK, inflation and interest rates rather went up to about 16%. Now, if you think about the interest rates around the world now, the Federal Reserve's what, 0.25%. The Bank of England is 0.10%. The Bank of Japan is negative interest rates. The Swiss National Bank is minus 0.75%. So that means when you get a mortgage or a loan, the interest rate payments are very low. But my parents were paying interest rates of 16%. So I know in some countries that you'll have high interest rates as well. So if interest rates start going up very quickly, it does have a domino effect. Now, my personal opinion is that so many people are so indebted that central banks around the world really won't necessarily be able to raise interest rates quickly. And it will quickly become a political issue. Could you imagine if, 50% of a country's population loses their house because they can't afford the repayments, then they'll have to keep interest rates low. So Pascal, it's a problem and it's not a problem at the same time. So as long as the Federal Reserve doesn't go bankrupt, as long as the US central bank doesn't go bankrupt, the rest of the world should be okay. But this is why you do have various doom and gloom analysts saying that, the Federal Reserve's taken on too much debt. What happens when the US can't repay their debt, et cetera, et cetera. You have various doomsday scenarios. So your question is great, Pascalis, because it shows you're aware of that issue and it is an issue. And if interest rates raise too fast, too quickly, it has a knock-on effect. Yet, Shaman, earlier you mentioned these days central banks have no intention to currency manipulation. What do you think about the statement which made by the Bank of Canada about the US dollar CAD rate? Shaman, that's an excellent point. Now, there's a difference between currency manipulation and letting markets know that you're concerned about the rate. So what Sharman's referring to is when the Bank of Canada's Governor Coghlan, said that I'm a bit concerned, the Canadian dollar is highly valued. That's the language they use. I'll show you what got his concern. So here's the US dollar Canadian dollar currency pair. And this was the last central bank decision on April the 21st by the Bank of Canada. And you see the way the US dollar CAD fell so quickly? Well, the reason it fell so quickly is because the Canadian dollar strengthened, because the Bank of Canada said they were going to taper their quantitative easing. So they were going to wind back their quantitative easing program. And remember, when a country expands its quantitative easing, the value of the currency falls. So when it winds its quantitative easing back, the currency gains. The falling US dollar CAD is a gaining CAD. This was a trade that I took. I took a US dollar CAD short position for exactly that reason. Now, price has gone a long way. So from 1.25 down to 1.20. Now, Canada's biggest trading partner is the US. Remember what I said? If a currency gets too strong, what does it hurt? It hurts its exporters. So what does a good governor want to do? Wants to help its exporters. So the governor is saying, look, I'm worried about the strength of the Canadian dollar. Now, that doesn't mean, Charmin, that he's going to all of a sudden come in and cut interest rates. It doesn't mean that he's going to start buying the US dollar to artificially cap the US dollar CAD level. But it does mean that, he's going to be a bit slower to give a rosier picture to markets, doesn't it? He might be a bit slower to stress the positives and a bit quicker to stress the negatives. And then lo and behold, you can see the last central bank meeting that we've just had from the Bank of Canada. And this was what I put on my website today. What do we learn from the Bank of Canada? In a sentence, not a great deal, but I put 4 points. I put 3 points to note. And it's just basically, they're a holding kind of meeting, So, Charmin, you raise an excellent point. So I think Governor Coghlan wasn't motivated to be very optimistic because he didn't want the Canadian dollar to strengthen. So although central banks don't manipulate currencies in the way the Swiss National Bank did, they still manipulate currencies by the language they use. So your question helps clarify my point, and it's an excellent one. Thank you. Hope that makes sense, Charmin. Hope you sort of can see that nuance there. Okay.
All right. Wow. I mean, I do not trade in foreign currency, but this has been quite, I think, informational even for me. And I mean, there's no topic or sort of no insight there which seemed too complicated. So when we upload this on our YouTube channel, like we have the past videos, I am going to make sure that it is titled Secrets Behind Successful Trading. And because it really was. And thank you so much again. And thank you everyone for attending. Like I mentioned, if you did miss this, you can catch a recording on Murdoch University Dubai's YouTube channel in a couple of days. And please, yes, do follow all the resources that Giles shared himself. And I will follow you on Twitter now.
That's brilliant, Manuja. I know my mistake. It was the title made it sound so boring, didn't it? It's my own stupid fault. I'm too conservative.
You obviously know exactly what you're talking about. I think we just needed to make sure it's a little more clickbaity.
Yeah, I know. It needed to have a sexier title, didn't it? That was the problem.
No, but this has been amazing, really. And yep, as someone else has commented as well, very impressive. Thank you so much. Have a lovely rest of your afternoon there. It's almost 5 p.m. here, and everyone else, wherever you're joining from, thank you again. And
yeah, thank you all very
comments?
much. Thank you for hosting me today, Manuja. It's been an absolute pleasure, and have a very good day in the sunshine in Dubai.
We shall. Thank you. Bye, everyone.